What's a margin call? The term margin call was processed by Hollywood in the film of the same name and equated with fraud in high finance. However, that has little to do with reality. A margin call therefore often hits private investors and is by no means pleasant. So, what is the definition of margin call? When trading certain financial products, it is not necessary to actually deposit the entire amount that is being traded in your trading account. It is sufficient to have a so-called margin, which is only a fraction of the traded volume, as security on the trading account. This gives the investor the opportunity to trade with much higher sums than he himself has in assets. On the other hand, it is more risky. He can lose more money than he actually has in his trading account. In this unfortunate case, he receives a margin call from his broker asking him to compensate for the loss. As is so often the case in finance, the term margin comes from the English expression to margin, like limiting something or allowing a margin. In this case, the investor's financial leeway is limited. If he exceeds this limit, he must ensure compensation. Who can a margin call affect? Anyone who trades in stocks or warrants can rest assured. Since he buys the shares in full, his maximum loss is also limited to this stake. Even if the leverage with warrants offers higher opportunities as well as risks, the full amount is always to be invested and an obligation to make additional payments is therefore excluded. This affects transactions that are carried out via the futures exchange, as well as foreign exchange and CFD trading. Trading on the commodity futures exchanges is hardly accessible to private investors. Trading with CFDs and forex trading, currency trading, forex equals foreign exchange, have recently been heavily promoted and attract with great profit opportunities. These chances of big profits are due to the fact that up to 400 times the leverage can be traded. However, it should not be forgotten that due to the high level of leverage, the risk is correspondingly higher and so the loss can quickly exceed the security deposit, the margin. How do you protect yourself against a margin call and the consequences? Well, as with all financial transactions, the first protection in order not to receive a margin call and the associated obligation to make additional contributions is not to trade products that you do not understand. Even if the advertising for CFD and forex trading repeatedly advertises how easy it is to get started with these trading opportunities, one should always be aware that the leverage of these products works in both directions and, in addition to the opportunities, also entails major risks brings. Only those who know the products and markets, who understand how to work with the sensible use of stop, loss and who practice adequate risk management can be successful in the long term. For everyone who takes the first steps in these markets, it is advisable to look for a broker who has built in a break, for example closes all positions when the critical loss limit is reached and does not allow any further trades. There are now some providers who offer such loss protection, which is highly recommended.